$250 billion for xAI? I feel like I need a cold shower.
You and every other banker. But come on, Nate. It's literally Elon buying from Elon.
The ultimate left pocket, right pocket deal. But you can't ignore the trend. 12 deals over $10 billion this quarter. Busiest since 2008.
Deal volume is up, sure, but $250 billion for a related party transaction. Let's read the actual footnotes on this SpaceX paper. The rundown.
$1.7 billion. That is what Verdi Partners just handed Klarna in structured finance.
Handed is doing a lot of heavy lifting there. It is structured finance, Nate. You know they buried the liquidation preferences so deep we will need a backhoe to find them.
Spoken like a true journalist who assumes my banker friends are always setting a trap. But you have to admit, it keeps the buy now, pay later dream alive for another quarter.
Barely. But if you want to talk about questionable capital allocation, look at Intel. They are dropping $14.2 billion to buy back a 49% stake in their Ireland fab joint venture.
Wait, they are buying it back? I thought the whole point of that JV was to offload the massive capital expenditure.
Exactly. They spun it out to save cash, and now they are buying it back at a premium. The regulatory filings drop tomorrow, and I guarantee you the footnotes are just a giant crying emoji.
Total corporate whiplash. Speaking of whiplash, the gossip mill is spinning out of control this morning.
Give me the rumors. I need something to wash down the Intel news.
Uber is supposedly circling Blacklane to expand their high-end chauffeur offerings. But the real whisper is Estee Lauder and Puig. They are apparently advancing talks on a massive, predominantly stock-based tie-up.
Oh, come on. Puig just went public. Now they want to merge in an all-stock deal. That screams desperation from Estee Lauder. Their stock is way too volatile to be a reliable currency right now.
I completely disagree. It is a brilliant prestige play. Estee needs that European luxury edge, and Puig gets instant global scale. You are way too cynical about stock swaps.
I am perfectly cynical. I like cash. Like the $380 million in private investment backing that Cyclerion and Corsana Biosciences all-stock merger. See? Cash makes the stock medicine go down.
Fair point. Or you just do a clean buyout, like Antene Infrastructure taking Sapphire Gas Solutions off Apollo's hands. Apollo gets an exit, Antene gets compressed natural gas. Simple.
Classic sponsor-to-sponsor handoff. But honestly, all of these feel like pocket change compared to the macro numbers. First quarter deal value just hit $438 billion.
A 5-year high, up 155% year over year. 12 mega deals over $10 billion.
And we know exactly which $250 billion elephant is skewing all of that data.
Oh, we are definitely talking about Elon. The big one. $250 billion. I just need to say it out loud so my brain accepts it. $250 billion.
And all it took was Elon Musk looking in the mirror and deciding to buy his own reflection.
Come on, it is a little more complex than that.
Is it? SpaceX is acquiring xAI. The CEO of SpaceX is handing $250 billion of hypothetical value to the founder of xAI, who happens to be the exact same guy.
Look, I get the skepticism, but you cannot ignore what this does to the Q1 numbers. We hit $438 billion in total completed deal value for the quarter. That is a 5-year high.
Right, but do the math. Over half of that total is literally just this one incestuous transaction. If you strip out SpaceX swallowing xAI, the quarter is actually pretty average.
I completely disagree. We had 12 mega deals over $10 billion this quarter. 12. We have not seen volume like that since 2008.
And we all know how 2008 ended.
Stop it. You are ruining my bullish banker narrative. The analysts are calling it a 155% year-over-year surge. Dealmakers are finally feeling confident again because the macro environment is stabilizing. Legacy companies are terrified of missing the AI boat.
I agree with the legacy panic, but SpaceX is not a legacy company, and this valuation is pure fiction. I dug into the footnotes on the transaction structure. There is zero cash changing hands. None. It is an entirely paper-based equity swap designed to consolidate balance sheets.
Which makes perfect sense from a corporate finance perspective. You are a private space company trying to get to Mars. You need massive compute power to run orbital simulations, and xAI needs massive infrastructure to train its models. Why not merge them?
Because valuing a 3-year-old AI startup at $250 billion is a total hallucination. It is $50 billion higher than the GDP of New Zealand.
Okay, that is a fantastic stat. Did you just have that ready to go?
I keep the GDP of New Zealand handy for exactly these moments. But seriously, I want to see the fairness opinion on this deal. Can you imagine being the poor associate at whatever boutique bank had to sign off on this valuation model?
Oh, they definitely did not use a bank. They probably just asked Grok to generate the fairness opinion.
You are probably right, which is terrifying.
Terrifying or not, AI is dragging the entire M&A market out of hibernation. It is setting a floor for valuations. And it is not just the mega cap tech guys moving money around. Look at the legacy hardware players frantically trying to clean up their own messy joint ventures.
Exactly. Which is the perfect pivot to what Intel is doing with its Ireland fabs, because $14.2 billion is a massive check just to undo a previous deal. Tukise. Voices.
So I'm reading this analyst note from this morning, and they're claiming this 155% year-over-year surge in Q1 deal value is all about renewed confidence and improved macroeconomic conditions.
Oh, please. Renewed confidence? Have they looked at the actual deals?
They're looking at the volume, Maya, $438 billion in a single quarter, 12 mega deals over $10 billion. We haven't seen that since 2008.
Right. But strip out the SpaceX acquisition of xAI. $250 billion for one deal. That's more than half the quarter's total volume right there. It isn't macroeconomic confidence, Nate. It's pure, unadulterated AI FOMO.
Okay, fair. The Elon math completely skews the average. But other industry observers are pointing out this massive wave of legacy companies panic buying AI tech. You can't deny the strategy shift.
I don't deny the panic. I deny the confidence narrative. Look at Intel. They're dropping $14.2 billion to buy back a 49% stake in their Ireland fab joint venture.
Which is a huge flex of capital.
It's a cleanup operation. I checked the early paperwork. They're trying to patch up their manufacturing narrative. It's corporate duct tape, not a victory lap.
Corporate duct tape for $14 billion. God, I love the tech sector. But fine, let's look outside of tech. The rumor mill is completely on fire right now.
Oh, I know. I'm tracking this Estee Lauder and Puig whisper.
A massive, predominantly stock-based tie-up in luxury beauty. If they cross the finish line by Friday, that totally wrecks your only AI thesis.
I'll believe it when I see the actual regulatory filings. But speaking of things we need to see the paperwork on, are we finally going to talk about Uber trying to buy Blacklane? Spill the tea.
So Uber's apparently tired of just being the app you use at 2 a.m. after too many margaritas. Now they want to be your private chauffeur.
You're talking about the Blacklane rumors.
Exactly. They're circling Blacklane to expand their ultra premium tier. It's classic Uber trying to own the entire transportation funnel.
I hate it. The margins on true white glove chauffeur services are terrible. You can't algorithm your way out of paying a professional driver in a Mercedes S-Class.
Oh, come on. It's an enterprise play. Corporate accounts don't care about the premium markup. They just want guaranteed reliability for their executives. Blacklane gives Uber that instant VIP footprint globally.
Fine, but I want to see the unit economics before I buy the narrative. Let's talk about the real drama, though. Estee Lauder and Puig.
Now that's a spicy one. The whispers on the street are getting really loud about a massive tie-up, and apparently it's predominantly stock-based.
Which is completely wild to me. Puig literally just went public. Why merge now? And taking mostly Estee stock. Have you looked at Estee's chart lately?
That's exactly why it makes sense. Estee desperately needs a jolt of energy. Puig has the cool factor. It's classic old money buying new relevance.
Or old money trying to catch a falling knife. I'm highly skeptical they can integrate those brands without crushing the exact thing that makes them cool.
Spoken like a true cynic, we'll see if it actually crosses the finish line by Friday.
If it does, I'm reading every single footnote on that exchange ratio.
Speaking of footnotes, I hope you have your reading glasses ready. Tomorrow, Intel is dropping the regulatory paperwork on buying back that 49% stake in their Ireland fab.
$14.2 billion to buy back their own facility. The absolute whiplash on their capital strategy is giving me a headache. Tomorrow's radar. I will be hitting refresh on Edgar at 6 a.m. tomorrow, waiting for the Intel paperwork. $14.2 billion to buy back that 49% stake in their Ireland fab.
You actually read fab joint venture filings for fun? That is a special kind of sickness.
Someone has to check how they are structuring the debt. Fine. What are you watching?
The beauty counters. The whispers are getting deafening about Estée Lauder and Puig trying to hammer out a massive tie-up before Friday.
A predominantly stock deal? With Lauder's shares looking like that? I do not buy it. The exchange ratio math would be an absolute nightmare for Puig.
Never underestimate a legacy brand terrified of being left behind. Also, Uber is supposedly circling Blacklane to build out their premium chauffeur service.
Wait, really? Uber just wants to be a fancy black car startup again. Time is a flat circle.
Right back where we started in 2010. We will see whose rumors turn into term sheets tomorrow.